And so much food for thought there indeed. Folks, we're going to remind you that all sessions happening right now this morning are in Conference Hall 1, and every session will have a Q&A panel on the right for you to submit your questions. You can also see the questions submitted by others. You also don't want to miss out on the exhibition hall. The entrance is via the arrows on the bottom left side of the main lobby. We have 7 strategic sponsors, 45 friends of STF 2022, and 7 brokers with the most profitable buffet spread of investment options and information you'll probably ever see. But now, it might be quite hard, folks, to follow a trend if you don't even know what it is, which is why our next session is something you definitely want to pay close attention to. We're going to be talking to our expert panel about the market outlook for the rest of this year. And this will be moderated by someone our Singapore viewers will be very familiar with. He's the host of the primetime afternoon show on Money FM 89.3. It's Mr. JP Ong. Over to you, JP.
Thank you so much, Edward, and good morning to everybody, and welcome once again to the Singapore Trading Festival. Unstoppable trends is the focus, and as you mentioned, Edward, you're correct. Identifying the trends might be the first point of order for our first panel and our first discussion. Of course, identifying that trend and the outlook has become a little bit more challenging because of how fast all the events shaping market looks is actually have actually developed. On one hand, we did see that in the last 3 weeks, we did see the Straits Times Index threaten, for instance, to fall or flirt with a fall below 3,100, and now you're seeing it sit pretty above 3,400, just showing you how quickly things can actually change in the markets. And there's a lot of moving parts, a lot of things to really account for, geopolitical, global, and even some local trends that maybe we have to take into account. Or do these things really matter for anybody who's trying to invest? Identifying this outlook is going to be very challenging, and I think that our panel is going to be very well equipped to actually handle this discussion. And we are very fortunate to be actually joined. I just noticed the coincidence. We are joined by 3 founder CEOs of their own groups. I would like to introduce them in this order. David Kuo, who's the head and co-founder of the Smart Investor, is with us today. We're also joined by Mr. Terence Wong, founder and CEO of Azure Capital. I speak to him almost at the end of almost every month to try and get a recap of the month that was and the lessons we've learned in Singapore. Of course, it's on prime time on Money FM 89.3. Shameless plug on my part there. Terence is also with us on the show, and also Raghav Kapoor, who's the CEO and co-founder of Smart Karma. So I think it's important to begin the discussion, of course, with, well, what is the market outlook now, especially if it changes almost from week to week? What are the things we're going to benchmark our outlook for Singapore markets on? And do these geopolitical events really matter, given how well the Straits Times Index and how well equities have bounced back in the last couple of weeks? I'd like to start off with David Kuo, the head and co-founder of the Smart Investor, to share with us some comments and his thoughts. David, I'm sure that you have a lot of things that you and a lot of points you want to bring up also, and a lot of things you're monitoring, especially with this fast-changing market, especially with this upward momentum right now. I'd like to hand off the floor to you for discussions. By the way, folks, you are welcome to ask questions, and we'll try to bring them up in a timely fashion as the conversation develops. But first, I'd like to hand the floor off to David for his thoughts and his commentary on how the markets have started and where we might be heading, especially markets here in Singapore. David?
Okay, thank you, JP. And good morning, Terence, and good morning, Raghav.
Hey.
Look, we are in a very confusing place at the moment. And when I was asked to join the panel this morning, I thought, what do people want to hear about? Do they want to hear about COVID? Do they want to hear about rising inflation? Do they want to hear about impending rate hikes? Do they want to hear about what is going on in Ukraine and Russia? So there are lots of people who are very worried about a lot of things that are happening. Now, how do we invest? How can we possibly invest in an environment where so many things are happening at the same time? And I have a rule about investing, which is that we should never allow events outside of our control to affect the way that we invest. Now, we can't control inflation. We can't control interest rates. We certainly can't control what is going on in Russia. So how do we invest under those conditions? And my focus is to control the things that we can control and ignore the things that we can't. So what can we control? I run 3 very visible portfolios on the Smart Investor. And I say to the subscribers to those portfolios, look at the right things, not the wrong things. A lot of people, I mean, we heard it this morning, the traders, Michael Covell, talking about price action. We can't control the price of a share. We can't control the price of oil. We can't control the price of nickel. We can't control those things. So why would you even want to attempt to control those things by following, say, trends? You can't do so. So what I say to my subscribers is, look at the one thing that you can control on those portfolios, which is cash. You can control how much cash is going to be generated from your portfolio by investing in the right stocks that have the ability to spit out dividends and cash. So focus on how you can invest in the right stocks that will produce the income that you require. Now, out of the 4 of us, I can tell that I'm the only one that's got gray hair, right? And the reason why I've got gray hairs is because I'm getting old. And we will all eventually get old one day. And when we get old one day, what do we want? We require a steady stream of income that will be able to sustain us through our old age. So what these portfolios do, or what your portfolio should do, is to generate the cash that you require. Out of the 3 portfolios, the amount of income that was generated this year is more than the income that was generated last year. Last year's income was more than the years before, and that year's income was more than the year before that. Now, what has happened to the share price over those 4 years? I have no idea, and I don't really care. Why? Because all I care about is the income that is generated from those portfolios. Now, traders will be saying, oh, I got to see what the Singapore index is doing. I got to see what this share price is happening. The only time you look at the share price is when you are reinvesting any cash that you have, and you hope that the market is stupid enough to actually drive down those share prices so you can buy more. If you can buy more, it means that the following year, provided those companies continue to do well, you will earn more income. Because what you are doing as an income investor is you're buying dividends. And you buy dividends when share prices are low, it means that your future income will be higher. So I guess my watchword for everybody who is following this discussion this morning is focus. Focus on the one thing that you can control and ignore the things that you can't. And in my case, it is following the income that my portfolios are generating, and provided I buy the right stocks, and that is the key. You've got to look at the right stocks. You've got to follow the fundamentals. You've got to be able to identify what is this company going to do. I'll give you one really, really good example. About 30 years ago, I bought into a company called Unilever, a boring company. Unilever makes soap powders. Unilever makes those shampoos that we use, the Dove soaps. It also produces some food. At that time, when I bought Unilever, the share price was £3, right? I was in the UK at the time. It was £3 a share. Unilever went through the dot-com bubble. Nobody wanted to own Unilever. Everybody wanted to buy the dot-com shares. So Unilever's share price fell. How much are Unilever shares today? £30 a share, right? So the shares have gone up from £3 to £30, a tenfold increase. It's gone up, it's gone down. But what has always been steady is the amount of dividends that the company has been generating. Take those dividends, reinvest them into more shares, and in my case, you can't go wrong. So I would like to close by saying focus. Focus on the things you can control, ignore the things that you can't. You can't control share price, but you can control the amount of income that you are going to be earning from your portfolio. So thank you, JP.
Not unmuting. It's early in the morning. I'm still in my second cup of coffee. Apologies, folks. But thank you so much, David. A lot of interesting insights and a very unique perspective and approach and how to view the markets. So not looking so much at the price, but actually looking at the buying opportunities and what you can control, focusing on the cash that it can actually generate. And I think this is also a strategy that's proven quite well in times of heightened uncertainty. But this uncertainty is making it a little bit more complicated to actually determine which way the markets are going. It might be nice to know which, if the markets are perhaps trending in a certain direction so that you can actually figure out what our strategy is. I'd like to bring Terrence Wong, the founder and CEO of Azure Capital. And Terrence, I know we're a couple of days early from our end of the month chats on Money FM, but I'm sure that you too have been looking at the markets quite intently also. And, I mean, David laid out a very interesting point. Don't get too consumed with where everything, or get too obsessed with where everything is heading in the short term on a day-to-day basis. But I think it's also been very difficult to really figure out what's been driving markets in Singapore. Now, there is also the case that despite all of the noise that's going on outside, we've seen the STI, if you're just using that benchmark, go from strength to strength. I mean, share with us your thoughts on how this sort of fits into a market outlook for the year, and if the STI will continue to once again perhaps ignore some of the geopolitical noise that better than say some other markets out there.
I know, right? I mean, STI has seen quite an amazing run over the last couple of weeks. Not too long ago, I remember it was just like a week and a half back. Everything looked so bleak. But even at a point in time, we outperformed the likes of Hang Seng Index, the China Index, by a mile. And I think this year, looking at the market, I would think that it is a little bit more difficult. Last year was quite clear. I mean, there were a confluence of positive factors coming in. This year, it seems like it's a bit of a tug of war, like what David spoke about. There's inflation and then ending on to war. And on the other hand, we have PM coming in to say that we are going to reopen. Things are going to look exciting again. So all the reopening plays started to sort of run up. And there's the hospitality, the usual suspects like hospitality, the airlines, consumer, F&B. But of course, I think the major issue to really focus on for this year at least will be inflation. That's something that I thought was going to be market changing. There is going to be some impact or some heavy impact on the market when it comes to inflation, and the war just made it a lot worse. I think sometime early last year, Jerome Powell, the Fed chairman, was saying that, hey, the inflation is only transitory. It will come and go. By November, I think that narrative has shifted. And I think it's very important that even our own central banks, we actually made a shift mid-cycle, and that is atypical. I believe that inflation is here to stay. You can see from our bills, right? The electricity bills. You can just walk all around, and you realize that prices are or drive around, and you can realize that prices have gone up significantly. So there will be companies, there will be sectors that I think can benefit or lose out from this inflation run. So these are some of the major issues that I think investors will have to focus on.
Mm-hmm. Let me, before I get to Raghav, and I really want to get Raghav's thoughts also on the market outlook, I want to try and thread your points and try to build it on top of what David's laid out for us so eloquently just a couple of minutes ago. As we've noted, it's been very, as a journalist, it's been very exciting to watch the STI, because about 3 weeks ago, there were shudders about, is it going to fall below 3,100 because of the war in Ukraine? And now you're seeing it go from strength to strength, 3,400. It seems to be all about the reopening play for the most part. I mean, does this sort of support David's outlook, Terrence, do you think? That maybe there's a lot of, maybe the market noise is not going to be as important, and maybe following trends obsessively is not going to be as important as, say, focusing on what you can control.
Well, I think for the first part, the first jump that we saw before the reopening was that, global markets just decided to recover. And we also like rode along with that. So as it was, like you said, flirting to like break down below the 3,100 mark, and then Hang Seng made an amazing recovery. We went up together with them, and then followed by the very recent reopening. Well, I do think that, if you're a really long-term trader, and I totally respect what David's all about, we had discussions regarding this, and he's someone that's really, really consistent and believe and basically like follow his rule, and he has done very, very well, right? Well, for others, I think that it's very, very difficult to change their mindset. There are people, since this is a trading festival, right? There are people that are traders out here, and they do have to ride with certain themes. And I do believe that there are, basically, there are basically some sectors that will actually like I said, there are winners and losers in various themes, and in particular, war. There's inflation, there's reopening, and all these things I think investors would be able to look into.
Very well put, Terence. Now, I'd like to bring Raghav Kapoor into the discussion as well. And Raghav, we'd love to get your thoughts also on which way the markets are going, what the outlook might be for Singapore's markets and their place as the rest of the world figures out which way to go, what the trend will actually be over the next couple of months. It seems to change all the time. But I remember before this discussion, you actually identified a couple of factors or points that you're looking at from looking for value restructuring for Singapore companies, and also which way capital flows are actually going within this region. I'd love to give you the floor now to just outline some of these points that you're actually looking at, and maybe even thread it into some of the talking points that both David and Terence have laid out in the last couple of minutes.
Yeah, thanks, JP, and really, really nice to be here this morning. And David, I think that was a very good introduction to how you look at the world. At Smart Karma, we have the benefit of listening in to some of the best minds in independent research around the world, with a special focus on Asia. And within that, we try our level best to look at what we describe as asymmetric alpha opportunities. There is no point putting on a bet where your chances of making money are the same as the chances of losing money. So we're always looking for those asymmetric opportunities. That tends to be the bigger and broader focus of the independent research community on Smart Karma. So Singapore as a market seems very exciting for us in the regional as well as global context this year, because it presents a few different degrees of asymmetry. And I'm going to weave out some of those themes today. So I think first and foremost, probably the most asymmetric macro theme that is working in favor of Singapore, and it will continue to work for a period of time, is regional capital flow. Singapore's status as a safe haven has been underscored, emboldened, and really, really entrenched now in the minds of the global financial community, first through COVID, and now increasingly through some of the other uncertainties we're seeing. The policymakers here have done a very, very good job at protecting both lives and livelihoods, and we're coming out quite strongly out of COVID. We're starting to see, just if I look at Smart Karma's institutional client base, for instance, we're seeing a lot of jobs now moving into Singapore. Some of these are moving back to Singapore, and a lot of these are altogether new jobs that are coming here. That is not something that we can say of the other major financial centers in Asia, at least at the moment. So this beneficiary of regional capital flows as a broader thematic is probably the strongest trend working in favor of Singapore. And when I was listening to the previous speaker, Michael, I felt that actually the strongest trends are the trends that are beneath the surface. It's just like the ocean, right? The strongest currents are not at the surface of the ocean, it's beneath. And this is the strongest trend beneath that's driving everything else. Crazy Rich Asians wasn't, I don't think it was just a serendipitous title. Singapore is becoming that seat for affluence, that seat for financial control, and it continues to compound in that direction. Secondly, I think another trend which is very, very pronounced now in Singapore is a trend about minority friendliness and restructuring to unlock value. So we've definitely seen that being kicked off by the Temasek linked companies, the TLCs, and it is starting to percolate, through the universe of listed companies here. So I'll give you an example. Just over the last few months, we have seen the Olam Group unlock significant value through restructuring. They split into 3 companies. Now, just overnight, they've announced a sale, a 35% stake sale to a large Saudi investment company, which is being done at almost twice the implied value in the current share price. Now, we are seeing that one after another. Several companies are taking turns to look very, very closely at the businesses they're operating, divest the ones that do not generate enough returns for shareholders, and double down on the longer term investment themes that are coming out. And I think this sort of restructuring unlocks that asymmetric alpha. You will not be able to capture it by looking at just price trends. You will not necessarily be able to capture it by looking at the returns they've generated in the past. But I think you'll have to do something a little bit different, which is have your ear to the ground, be speaking to the management teams, be listening to independent research, and really understanding these opportunities one at a time. And I think the very, very last thing I'll say is, there are people in this room, there are traders who are growth investors. There might be income investors, maybe David's more in that camp. There might be thematic investors, looking at themes like reopening or inflation and so forth. But I think what's quite cool about Singapore is, despite it not being the biggest market in Asia, but it seems to have a very good balance between all of these things. We like the fact that there's something for everybody, even though it's a bit of a, mini-cosm, right? I wouldn't call it a microcosm, but it's a bit of a mini-cosm. And hence that gives Singapore a bit of an evergreen status. So today, we are clearly seeing in all the data we track liquidity very closely, which is the flow of capital. We're seeing a very, very clear rotation away from some of the North Asian markets towards ASEAN. And within ASEAN, Singapore is the biggest overweight. And I don't think that gets displaced anytime soon, given those undercurrents that I spoke about.
Just an extension
Go ahead,
what
Terence.
Raj was talking about, and I do agree with what he mentioned. If you look at our markets, we are actually a interesting market. There's a mix of growth and defensive plays, but largely we are seen to be a boring market, right? And that basically, if you look at what has happened in 2020, when the whole world was like rocketing up, we were seeing very, very pedestrian growth. Last year we outperformed because many of the value guys returned, and I think that value will continue to be interesting. The STI components out of the 30 guys out there, 80%. Some dividend paying considered to be more value plays. So in this really uncertain world, I think that there is an argument made that Singapore will continue to outperform.
Mm-hmm. Very interesting points there. I before I continue, I just want to inform and address the attendees. I am seeing the questions you're posting, and they're very interesting questions, and we will get to those in just a bit. But I do want to continue this the discussion between David, Terence, and Raghav here on this particular panel. David, I want to start off with you. Raghav Kapoor brought up a very interesting set of trends that he's looking at and possible factors to watch out for: the restructuring of these Temasek-linked companies, the regional outflows. And, you outlined that it's important to follow or perhaps look at what you can control, which is cash generation. I do want to ask you about whether or not you have a particular checklist, because the big question for investors might be, okay, we can follow the cash, we can follow what's generating dividends, what's generating value for us. But how do we go about it? What do you look out for when you spot when you're trying to hunt for some of these possible opportunities based on what you've outlined? And how do the trends that Raghav outlined a while ago perhaps fit into a potential checklist, or does it at all?
Of course it does. And I think one of the key metrics that I look at for a company is whether or not it has a high return on equity. In other words, is the company able to generate a large amount of profit for its shareholders. So ROE for me is probably the rocket fuel for any company. A company that has a high ROE is capable of generating extraordinary profits because it's not using a huge amount of shareholder capital. Now, if you couple that with a company that can pay dividends and it retains some of that profit, obviously it has to pay some of that profits to shareholders because as a shareholder, I need to be rewarded. So they can retain some of that profit to reinvest in the business with a high ROE, then you actually have an asset, a machine that is capable of driving long-term returns for shareholders. So ROE plus some retained profits in the business will be able to sort of drive value or drive returns for shareholders. And when you look at those kind of companies, right, I'm going to play a little game with you, JP, right?
Sure.
Right. Here's a sentence. Blank, fill in the blanks, right?
All right.
Does not turn.
By the way, Terence Raghav, feel free to join in as well.
I was just going to, can I join in too?
Wait, David.
Okay, right. Blank does not turn a good company into a bad company, right? So fill in that blank. So you can say Vladimir Putin does not turn a good company into a bad company. Donald Trump does not turn a good company into a bad company, right? Interest rates does not turn a good company into a bad company. So whenever you have exogenous events outside of your control, inflation does not turn a good company into a bad company. It cannot do so because if you are a good company, you are going to be able to survive regardless of the conditions that you have. So whenever you hear an event outside that says, interest rates are going up, does higher interest rates turn a good company into a bad company? No, it doesn't.
But it can turn a good stock into a bad stock.
Right. Good point, Raghav. Mm-hmm. It can turn a good stock into a bad stock because the stock price is controlled by people's emotions. So people will say, I think that REITs will not do well in this environment because interest rates are going up. But what they tend to forget is that interest rates are going up. Why? Because there is inflation in the system. When there is excessive inflation in the system, what do REITs owners, landlords do? They will start increasing the rentals. So inflation is not really bad for REITs. In fact, it could actually be good for REITs. So inflation doesn't turn a good REIT into a bad REIT. It cannot, right? Because a good REIT will be a good REIT. If you are a REIT owner that has properties along Orchard Road, the economy is opening up, tourists are coming back into Singapore, and if you are a shop owner, where do you want to be? You want to be on Orchard Road. And if you want to be on Orchard Road, well, the landlords are saying, this is the rental. This is how much you have to pay. So inflation doesn't turn a good REIT into a bad REIT. A bad REIT will be a bad REIT, regardless, right? There's nothing you can do about that. And you have to avoid the bad REITs, no matter how high the yield is and how attractive it might be. You have to keep that away. So whenever you hear of events outside, ask yourself the question, will it turn this good company into a bad company? And if your answer is no, it won't, then take advantage of lower share prices and buy. Yes, JP.
Right. So this seems to go towards, and I'm glad you brought up these points because this seems to go towards identifying good management, good governance. And by the way, this is a point that comes up in a lot of my conversations with Terence at the end of the month, always looking at management, governance. Raghav, I've scoured through Smart Karma on many occasions, and a lot of your analysts also there talk about the importance of good governance and management. But again, it brings us back to the question, and I'd love to get your various opinions and to get your checklists. How do you guys separate the wheat from the chaff? How can you determine whether or not it's a good company or a bad company that can weather a lot of these blanks that you just outlined, David? Maybe I can start with Terence first. I'd love to hear from Terence first, and just open the floor to either David or Raghav to follow up on conversations. Just let it be free-flowing. What's your checklist, Terence?
Well, for me, it's really a no-brainer. What I do since my analyst days, and that's like 22 years ago, I constantly visit the companies, I speak to the management, and it is, you cannot really tell right from the get-go, right from the start. You won't be able to tell whether there's a good management, good company, but it's over time where we really understand the management, and that during good times it's not very difficult because everything's just like flying high, right? But it is during the bad times how honest the management is. There are some that will try to blatantly hoodwink you. Then that's off the checklist. Obviously, before that, we'll go through all the rigors. We'll look through the financial numbers, and we need to just make sure that things are aligned like what the management tells us. But there are occasions, I would like to say, that it could be a fantastic company, great company, and against its peers, it really stands out. I'll give you an example. Venture back in year 2000, contract manufacturers were all the rage, right? Prices just went up significantly. 3 out of the 4 big contract manufacturers were sold out to their rivals over in the US, leaving just one guy, Venture Manufacturing. Now we know it as Venture Corp. Venture Manufacturing went as high as $29. Many investors actually piled it because they thought it was a great company, and it is. The management, I would feel that it's one of the best in town when it comes to running a contract manufacturing business. So many people piled in when it was like $20 odd, but it was really at the height of it. It started to fizzle. The business continued to run really well. It is a good company run by good management, but the prices just went south, and it stayed there for close to 16, 17 years before actually like even hitting anywhere close to where it was back in year 2000. So I know that a lot of people were hit by companies like Venture, good company, but turned out to be a bad stock. And even though over the years they have consistently increased their dividends, so I think that that's something that investors will have to look out for. Don't go in when there's a mad rush. Let things fizzle. But it's also easier said than done because we don't know when's a good time. Because at that point in time, it was trading at close to 30 times PE. You would think that 15 times PE is reasonable because it's only half of the peak. But even after going down by half, it halved again, right? So it is very difficult. Just looking at the PE, just looking at some of the metrics and historical measures. So investors generally would have to be very careful.
Yep. If I may add to that, right?
Sure.
I kind of actually, interestingly, I sit sort of squarely midway between sort of David's philosophy and what Terence just described, and I see great merits in both. Actually, we've I guess tried to find a hybrid approach between two. So
Raj, you got to join one team.
No, so I'll tell you. I'll tell you how we do it, right? So we're increasingly working very closely with some fund managers who are starting to run almost dedicated portfolios or strategies around what we bring to the table at Smart Karma. And the way it works is as follows. It's a 3-step process, and just bear with me for a second. It's not very long. The first step is really trying to identify the best ideas from the best analysts. Now, historically, that's been a very hard thing to do because how do you know who's a good analyst and how do you know what idea is the best idea? So platforms like Smart Karma collect a lot of quantitative structured data around every analyst call, its performance, and attribution. Terence, when he writes on Singapore companies, his ideas are amazing. But if I maybe ask Terence about Philippines, it might not be the same level of conviction or performance. So we do that. So we can always build a short list of best ideas from best analysts on our platform. Step 2 is a step where we go into David's territory, where we look at the long-term attributes, the long-term merits, and we exclude a lot of companies based on that. And I will tell you the 3 key metrics we look at. So we do not look at ROE, David, simply because the balance sheet of the company can cause vast swings in ROE. You know, a highly geared company will show a better ROE than a less geared company. And we don't like that. So we look at return on invested capital. You know, for every dollar that you put into the company, how many cents do you get back? So we look at long-term 3 to 5 year sort of average ROIC. That's a measure of performance or efficiency of a business model. The second thing we look at is compounded growth in dividends, absolute dividends. We don't care whether the yield is 5%, 10%, 1%, 0.5%. As long as the absolute dividends keep growing. That tells us the business is doing well, and also that the spoils are being shared back with the shareholders. You know, so an element of governance gets captured there very nicely. And the third metric we look at is net debt to equity. How geared is this business? And we try and avoid companies that have too much gearing because they just do not have the resilience during tough times. They end up diluting shareholders during bad times. So this is the sort of fundamental screen that eliminates more companies. And then comes the last step. And the last step is, well, how do you allocate your your finite amount of capital to that short list of companies, right? Who gets more, who gets less? And that's where we look at momentum. And we look at 3 types of momentum. First, we look at insider momentum. Are the insiders buying the stock? Is the company buying stock? Second, we look at momentum on our platform. Are analysts writing more? Are people reading more? Which tells you it's getting more popular. And the last momentum we look at is price momentum. Is the broader world also starting to buy into this idea? So you do not want to allocate your capital to businesses that will not perform for periods of time. They might be great companies, but bad stocks. What you want is great companies and great stocks getting majority of your capital. And we always layer on top of that what we call asymmetric alpha. Stocks that are going to do well relative to market, relative to benchmarks, regardless of market conditions, because the management are doing something exceptional for you. And that's where Terence's point, ear to the ground, speak to the management. And that's why we listen to the top analysts, because that's what they do all day long. Sorry for the long answer, but hopefully that helps.
That's very extensive, and I wish I pressed the recorder button on my phone right now when you were speaking, Raghav. David, anything you'd like to add to the various checklists that Terence and Raghav had laid out, or do you have your own specific checklist that might be a little different from their approaches?
Well, certainly the ROE for me is important. The amount of retained earnings is also important, but they need to also share that with investors. The other thing is cash flow. You look for free cash flow within a business because cash is king. Cash is always king. And a company that is capable of generating free cash flow can do all sorts of things with that cash. They can give it to shareholders if they want. They can use it for buying back their own shares if they want. If they believe that their shares are too cheap on the market, they can use that cash flow to buy back their own shares and thereby, increasing their earnings per share. That is also an option. So cash is always king. So going back to what I said right at the very start, focus on the things that you can control. And I'm glad that Raghav is in partial agreement with me, which is that companies have to share some of their spoils with their investors, because if they don't share some of their spoils, if they don't share some of those profits with investors, I am not that interested. Now, going back to Terence's point, 30 years ago, put yourself in my position. 30 years ago, I look at a company called Unilever, £3 a share. And I think to myself, at that time, PE was around 20, 25, dividend yield was around 3%. Is this a good company to put my money into? On most measures, it would be fairly valued. And this is what the analyst would say. This is fair value. And so therefore, I don't think there's going to be much upside. The difference between me as a private investor and anyone who is running their own portfolio and a fund manager is that the fund manager is accountable to the investors. I am only accountable to myself. And so therefore, I have that luxury by saying, okay, it might be fair value. I'm happy with a 3% dividend yield. I'm going to buy this and hold it. And I don't care what really happens to the share price. 30 years later, I've increased my investment tenfold, right? And during that intervening period, the share price will have fallen to maybe £2.50, £2.70. Some people would say, oh, sell. Other people may say it's gone from £3 to £6. Wow, great. Aren't I clever? I'll sell and take a profit. But in my case, because I am only focused on what the company can deliver for me, I can just carry on investing. And over that period, sometimes I'll buy at a higher price, sometimes I buy at a lower price, but I have that luxury as a private investor. Fund managers don't have that luxury because at the end of each quarter, at the end of each year, they have to write that report card and say to their investors, how much return have I given you? In my case, the returns are not important. I say, how much dividends have you paid me? And are the dividends you paid me this year, which goes back to Raghav's point about compounding that return, compounding those dividends that you generate. So for me, it's always about cash, Patrick, John Patrick.
Yeah, yeah, okay, important. Okay, there are a number of questions I want to get to, but I want to take this opportunity. I'm just curious now, and I want to take the frameworks you guys have laid out and apply this to a particular sector. So we talk about something, having a tangible track record for some of these companies, a clear vision, a policy for returning to shareholders, profitability, dividends, things that you can actually see and things that you can potentially control within your investments, right? So I want to get your thoughts on how we might apply this, say, to one particular sector that might not meet this this and that's a lot of the growth stocks, a lot of the tech stocks, the high-flying tech stocks. One criticism that the STI or Singapore has is that, there's not enough sexy tech stocks here, which is why you're not seeing as much of a growth. But when you look at some of these growth stocks, I mean, if I was to apply any of, say, especially Raghav or David's frameworks, some of these stocks perhaps aren't paying dividends. Some of these stocks are investing. And some of them might even have the audacity to say, oh, yeah, we're not really sure when we're going to turn a profit, but bear with us because we're just growing at the moment. In this particular space, how would you apply your frameworks to try to separate the wheat from the chaff? How would you use your frameworks within the growth and tech sector to perhaps identify the good companies from the bad companies? Or do you think that, given these frameworks, perhaps this is a sector we should just not touch at all?
No, I'll take that first, JP.
Go ahead.
Actually, we love tech stocks, and they totally fit the framework. So, like for us, if I just stick to the quantitative side of what I described, ROIC, actually the good tech companies have amongst the highest ROIC of any sector because they tend to be asset light and they tend to generate very large returns for small marginal extra capital, right? That's one. Second is a lot of them actually do pay dividends. They might just pay small in yield terms. So Tencent is a great example, right? Tencent has paid a dividend forever. It's just nobody sees it as a yield stock and we don't mind. We just look at, is that dividend growing over time, right? And hopefully is that dividend growing maybe a little bit faster than the growth of the revenue itself, right? So are they sharing more and more with minorities? So that's true as well. And third is net debt to equity. Again, these companies, a lot of them generate enormous amounts of cash and, their balance sheets tend to be very lightly geared. So that meets the criteria. Now, what does not meet the criteria is what I call concept tech stocks. As you said, pre-revenue, pre-profit companies. Those companies, honestly, I don't think should be listed. Or they should not be in the mainstream of retirement capital, for instance, because the valuation of that business is completely determined by the mood of the market. There is no cash flow coming back to you. So what are you valuing it on? It's a concept. And, look at ARK's performance over the last 6 months. It was full of these concept stocks. And the same companies are now trading 80-90% lower than where they were trading 6 months ago. Why? Well, because the market's mood turned. There's nothing tangible for you to fall back on. You don't know whether you should be buying more of this or not. You don't know whether this company is going to survive in a year or not. So that is a capital allocation decision. And to me, I put that in the VC bucket. Do you want to back VC? Venture capital ventures, private ventures. To me, those are like private ventures. They don't deserve a place in a retirement or a pension fund's allocation. outside of a very small percentage. Hopefully that answers.
David, Terence?
Actually,
Go
just
ahead.
to be sure, the tech stocks or the so-called tech stocks over in Singapore, and JP, you also know fairly well that they are largely manufacturing players rather
Right.
than the pure tech stocks, right? And many of these guys actually give out fantastic dividends to the tune of north of 5%, and they've been generating very, very healthy cash flows. So these guys are atypical, and you know how value market is, like as our Singapore market is, by looking at a traditional high growth sector, and all of them tend to be on the manufacturing side that gives out good dividends. They are low PE. These are supposedly growth guys that that operate very much like a value play. And this is by no coincidence. These guys have really reinvested in their business, and they have seen it grow. So even if you look at their book value, there is a certain level of book value, and many of them are just trading close to their books, or at 1 to 1.5 times book. Companies like Franken, AEM, Aztec, UMS, some of these guys that have done fairly well over the last few years, and I think they've basically been riding on the semiconductor, the demand for semiconductors, and as well as equipment, PCBs. So these guys are very, very different from the tech listcos over in the US, over in Hong Kong or China.
Mm-hmm. David, I'd love to get your thoughts on this. Oh, go ahead, Raghav.
I mean, I'll also add, right, what's tech and what's not tech these days. I mean, we can call Grab a tech company because they've got an app. Well, ComfortDelGro has an app. Is it a tech company also? Like, these gig sector classifications are totally bogus. I don't believe in them because sectors permeate. There's tech in everything these days. Are oil and gas tech companies? Absolutely. Is aircraft manufacturing a technology business? Yeah. I mean, I think we should not look at these things and be very fixated about the labels that people put on them. And I think, by the way, somebody mentioned Warren Buffett, I think, in the previous conversation. I think the man is great because he's got a simple framework, like David's framework, which I think is excellent. And he's stuck to it, and he doesn't give a hoot about what everybody else says. He likes to own the businesses he likes to own over long periods of time. It's that independent thought. It's the opposite of trend following. He's a trendsetter. People don't even see the trends that he is backing when he is backing them. So I think, I want to inspire independent thought in the minds of a lot of our traders. Build your own investor journey as well. Don't just listen to what me, David, or Terence have to say. Find your own appeal also. That's, I think, extremely important.
David, I'd love to get your thoughts on this particular point of discussion.
Okay. What I will try and do is to tie together what Terence and Raghav have said, because they both make an awful lot of sense. So the first one is you have to be true to yourself. If you are an investor, you have to actually set an objective and say, this is my objective for investing. And in my case, it is very simple. I need income. So I only look for companies that produce income. I don't mind if I miss out on those companies, those high growth shares that have done very well for other people. But if you don't pay a dividend, I'm not interested. So that's point number one. Point number two is something that Raghav said, which is, what exactly is a tech stock? Now, I have a group of companies in my portfolios that has been tech stocks, right? These are companies that were at one time very exciting, but now they start paying a dividend, and they pay quite generous dividends. So you've got companies like Apple, right? Is it a tech stock? Well, I would say, yes, it is, but it's not as exciting as some of the other tech stocks. So Apple is one, another one would be Microsoft. These are sensible companies that pay dividends. I'll give you two others, right? Which is probably going to sort of shock people. Visa and MasterCard. Are they tech stocks? Well, I would say they are applying technology to what they do, but they're also capable of generating dividends for me. And the dividend growth rates for these 4 companies is in the teens. Whatever they paid now, next year, they'll be paying in the teens increase in dividends. So why would I not want to own a company like that? The yield may be very low. The yield may only be 1% or less. But if you're growing your dividends in teens, chances are that your share price will probably go up in the teens as well. So I don't mind that. And what I would like to end by saying is that I'm sure the 4 of us can remember a time when we used to go for buffets, yeah, here in Singapore. You go to Copthorne Waterfront, you go to Straits Kitchen, you go to all those places for buffets. Now, JP, we don't eat everything out there, do we, right?
We try sometimes, but
yeah, well,
we usually fail.
We might try, but you are selective about what you want to eat, right? So you will go in the queues and say, hey, you know, I'll take some of that lobster because it's good value for money. If I'm paying $60, I'm going to have some lobster. What you do is you are very selective about what you put on your plate because you have a limited amount of time and probably a limited amount of space in order to eat what you have. And the same goes for portfolio building. You only have so much money to invest. And you have to go back to what you set out to do in the first place, which is to generate income. So you don't pay an income, call me when you actually start paying a dividend, and then I will start thinking about how you are doing. And then I'll wait about 3 years to see what your dividend track record is. And if I like it, then I will buy it. I don't have to be the first person in there to start buying your stock.
Okay, we have a number of very interesting questions, and I don't know if we'll get to all of them, but I do want to bring them up before we wrap up the session here. TT has asked us, we've been talking about metrics, signals, checklists here, and he wants to know if you have any key metrics and signals that you rely on to decide if an investment is not worth risking anymore and will cause you to say exit your positions. I think he's asking for possible metrics to use to perhaps give up the ghost during a time of a recession or a bear market. By the way, I'm not calling it a bear market at the moment. I'm not qualified to do that. But I think in the worst case scenario, do you have any checklists or key metrics or signals that you look at that says, you know what, this stock was good, but I think it's time to perhaps leave?
Well, I'll go first. Like for me, the one big no-no is bad capital allocation, especially beyond the sort of remit of a business. I'll give you an example that is not from Singapore. So AMC, which is a big cinema chain in the US, just went and bought a mining company. For me,
David's laughing, by the
for
way.
me, I'm like, thank you very much, but I'm checking out. Not that I was involved in AMC, but when companies do bizarre stuff like that without guiding or having any competence, that's one. That's not a quantitative metric, but it's very visible, right? It makes it to the headlines. The second thing for me is debt. I do not like businesses that are very heavily geared because I mentioned, you can just get steamrolled. When the margin call comes on a company, equity holders sit at the bottom of that seniority table, right? So you just get diluted. So again, if I'm noticing a company that's showing a dramatic increase in gearing for whatever reason, I'll step out.
Mm-hmm. Terence, David?
For me, I do visit, like I mentioned earlier on, I do visit many companies and I speak to the founders, the CEOs. One thing that scares me is when the founders treat the ListCo still as if he were running a private company. So he'll say that, I can do this, I can do that, I can control the board. That gives me the yikes. I don't like that. Because there is a board there for a reason. They are supposed to be independent, and they will tell me that these guys are my friends. I bring all my friends there. They'll listen to me. They're my yes man. And I feel that that's really to the detriment of minority shareholders. So these are companies that I tend to avoid.
Mm-hmm. David?
Well, I think there's a couple, and one of them is linked to something that Raghav mentioned, which is debt. A company that doesn't borrow can't go bust, right? I mean, it may not have a pretty good time, but if you don't owe anybody any money, you can't go bust. And you can ride out through the bad periods. But if you do borrow money, then you must ensure that you are able to cover the interest on the loans that you have. So interest cover, I think particularly at this time, is something that people should be looking at. Is the company able to pay the interest on the loans that it has? Because we know that interest rates are going to increase. And the second one is dividend cover. How well are the dividends that they pay out covered by cash flow and profit? So as a dividend investor, as an income investor, I need to know that the dividends that you are paying me is coming out of profits rather than something else. And so if you can, first of all, not borrow money, that's great. But if you do borrow money, can you pay the interest on those loans? And the second one is, if you're paying me a dividend, where is that money that you are paying those dividends coming from? I don't want to see a company that's borrowing money in order to pay me dividends, because that would be terrible. It would mean that you haven't got the cash flow. So for me, two things: interest cover, dividend cover, and
Right.
definitely no debt.
A lot of questions, or a number of questions actually from the group about the banks, the big three here in Singapore. I think it also plays into the dividend play, reliability, track records. Gordon and Lewis asked in different shapes or form if the three bank stocks that have done quite well in the last couple of weeks, if they've reached their peak price currently, or are they beginning to take off? And should this even matter, given we've talked about positioning yourself in a company and not being obsessed with the price action so much?
Okay,
Go ahead, Jarrett.
Okay, if you look at the banks, I think that plays into the inflation theme. Of course, there are other factors to consider, but then with the inflation setting in and the Fed's hands are tied, right? They do have to increase rates, and the fact that they're increasing rates, that will be very, very beneficial for the banks. All else remaining equal, of course. So Piyush, DBS CEO, has mentioned that for every bit increase, we're talking about to the tune of 20 million increase in the revenue. So let's say if there's going to be 150 bits, that's 3 billion, and that will likely see a record number. So of course, we're not going to wait till the end. I know David is going to shout at me, but then if you were to think about it, if you look at the previous rate hikes, I think the peak of the bank shares will be somewhere like 2 quarters before and if you follow the kind of trend, if it will be 2 quarters before where they end the rate hikes, assuming there's going to be 5 rate hikes. So I think we are still a couple of quarters away from peak valuation for the banks. The banks currently are trading about 1.3 times price to book. It is slightly above the average of, like if you look at the 5-year average of about 1.2 times, but the peak that they saw, the bank saw, was about 1.5, 1.6 times. So I think that there's still a little bit of juice left. Of course, if the world were to come off dramatically, then all bets are off, right? But then that again ties in with what David mentioned, because the banks are promising, especially DBS, they're promising quarterly dividends, I think 36 cents. So that would actually give some downside protection for the banks.
Mm-hmm.
Yeah, I think one thing that I'll highlight, I think very few people realize that Singapore banks have the highest exposure to the energy sector, to oil and gas, of all banks in the region. And we of course all know what's happening with that energy sector and energy prices. So that's a bit of a windfall, right? For the banks, to me, I think that the key thing now is, what do banks do with all that capital that they're going to make over the next year or so? That it's back to that capital allocation. Will they go and buy sensible stuff? Will they pay it back? Or will they go and do something that will destroy returns for investors? So I think we should watch the action of the management. We've already seen some big deals go through, right? We've seen the US banks sell off assets, and we've seen domestic banks buy them. Are these good purchases or not? Not too many people are spending too much time looking at that, but that's what we would be looking at. How is the money that you're making going to be spent?
Mm-hmm. Folks, we have about 2 minutes left before we wrap things up, and I hate to put you guys on the gun, but I do want to give you a short 20-second platform to just have some closing comments or words of wisdom for our attendees. David, I'd love to start off with you first.
Okay, stay invested. Regardless of what's going on, stay invested. Remember my catchphrase, nothing turns a good company into a bad company. right? So whenever you hear things outside, people telling you that, inflation is bad, interest rates are going to be terrible, it doesn't turn a good company into a bad company. But the key is to invest in good companies, good banks, good REITs, good consumer goods companies, good whatever, yeah? As long as the company is good, no debt, low debt, able to repay able to pay its interests and able to reward shareholders from the profits that it has, then just shut your ears, don't listen to what anybody has to say, and just follow the cash that is coming out from your portfolio. That's it, JP.
Terence? 20 seconds.
I'll be a tad cautious, 20 seconds. Okay, I'll be a tad cautious for this couple of quarters, even though there are some, I think, some value plays out there, because I feel that, the markets globally they are at lofty levels. I think that there could be one big shakeup. I thought 2 weeks back that was going to be it, but that was followed by a very, very sharp bounce. So I think that there is going to be another shock coming onto the market. So while we can stay invested a little bit later, right now I think it's time to cash up on some of your investments and wait for a better time.
Raghav, we've got 20 seconds.
Yeah, I think the first thing is Singapore safe haven. Keep thinking about that. That translates into stock markets as well. Second is look for asymmetry, and the last thing is stick with good quality.
All right. I'd like to thank the 3 co-founders for joining us today in the first breakout session for the Singapore Trading Festival. Again, lucky to have 3 co-founders and 3 veterans in the game to help us decide. And I hope we decided if the Lion City is going to roar in the year of the tiger, but perhaps more important, how do you identify these companies and how do you avoid the noise to make sure that you maintain or protect your long-term investment horizon, and also to make sure that you can also get some sleep, because it can be very confusing. David Kuo, head and co-founder of The Smart Investor. Terence Wong, founder and CEO of Azure Capital. And Raghav Kapoor, CEO and co-founder of Smart Karma. Thank you so much for joining us. I'd love to turn this over back to the main floor.
Thanks, JP. Okay, thanks, Dave.
Thanks, JP. And thank you also to our panelists. Again, Mr. David Kuo, Mr. Terence Wong, and Mr. Raghav Kapoor. To all of our viewers who are watching us via Facebook Live, thank you for joining us. We have come to the end of this morning's streaming on Facebook. So if you're watching us on Facebook Live, please join us now at the main event site by registering at sgtradingfestival.com. That's sgtradingfestival.com. We have an exciting lineup of speakers and topics, as well as exclusive content that's made available by our sponsors and the broker community that you wouldn't want to miss out. And also a very cool